But the financial basics for a real estate agent in terms of how to think about your business, for starters, you gotta just understand, and I think both of you probably do, that the purpose of business is to create profit. And if you're not creating profit in your business, stop, revisit, and try to figure out how come. But one of the things that I am going to tell you just from experience is that even though we know intellectually that the goal is to be profitable, because without profit, we can't fund our lives to the level that we want and deserve. But I can also tell you that probably one of the biggest challenges, believe it or not, for a coach is to kind of find a way to kind of crank up an agent's thermostat, meaning we have a lot of issues around money. We have a lot of issues with making a lot of money. And I think there's a lot of reasons for that. And I won't get into all the background, but I think, look, society wise, you just think about it. Money, you can fill in the blanks. Money is the root of all what? Evil, right? Money can't buy me. Unmute. Tell me
Happiness.
What happiness, right? Can't buy me happiness, right? Now I can tell you, I can be unhappy in a really nice place. But the point of the matter is this: we have all of these sort of ideas about money, is about being good or bad. I grew up in a family that we didn't have money. And so as a result, I can remember my dad railing against people that had money, the rich whatevers. And one of the things we just have to wrap our heads around, and I may be preaching to the choir here, but I always talk about it anyway, is that most agents find that they get to a certain level of financial success, and then there's kind of a pause. There's kind of a ceiling, because to break through that and get to a higher level of financial success kind of pushes buttons. Suddenly I'm going to be maybe more affluent than my family, more affluent than my peers. And there's all kinds of triggers that come with that. So I'm just going to throw out there that just understand that money is nothing but energy. It's good for the good that it can do. And what we believe in this company is we want people to dream big, and we want people to build a big financially successful business. If you think about the components of what the Keller Williams value and belief systems are, we've said for years that what Keller Williams believes in is a couple things. It's to build careers worth having, businesses worth owning, lives worth living. That was what it was for years. What was a business worth owning? A business worth owning is a business that's profitable. Careers worth having. A career is worth having if it's something that you enjoy doing. It's something that you wake up every morning and you're like, I can't wait to get at it. That's a career that's worth having. Right? I've had careers, and maybe some of you had as well, where, it's Sunday night, you're going to go back to work on Monday, and it's like this dread starts to come over you. It's like the angel of death starts to roll in at 7:00 at night, like in the movie, the 10 Commandments. Well, that's not what we want. You want you to have a career that you enjoy. But it's not just careers worth having, businesses worth owning. It's lives that are worth living. And recently we've added to that experiences worth sharing with other people, and legacies worth leaving. What we would love for people to do is build a business that's big enough that not only can you fund your life and make an impact in the world of the people that care about you and love you and you care about them, but what if you could build a business that was big enough that you could actually leave a legacy? The Millionaire Real Estate Agents that book is broken down into this idea of what would it take to actually earn $1 million, and what would it take to net $1 million, and all that stuff. Well, in the new version of the book, which hasn't come out yet, it's, Gary Keller wrote the MREA 2.0 probably 2 or 3 years ago. And it hasn't been released primarily because he's been focusing so much on the technology side of this industry, and because the technology is changing the way that we do things so rapidly that he held off on the release of that book. But I can tell you that he added into the mix not only earning $1 million and netting $1 million, but he also added in, leaving $1 million, leaving a legacy of $1 million. What would $1 million, gift to an organization that you cared about? What would that look like? So anyway, money is important. We're going to just recognize it's good for the good that it does, not for materialism's sake, but for the impact that you can make in the world. And so that said, a couple key areas of what we're going to talk about today are going to involve setting a profit goal for your business that's appropriate for what you're trying to accomplish. We're going to talk about how to set up the right structures in terms of your business accounting, your bank accounts. We're going to talk about the idea of actually paying yourself a salary. We're going to talk about making sure that you save the right amount of money for taxes and paying your taxes on time. We're going to be talking about reviewing your financials regularly. And then finally, how to protect yourself and the assets that you begin to accumulate in your business by making sure that you have the right kinds of insurances and all that sort of stuff. So those are kind of the key areas that we're going to talk about. And I think Anita just joined the room. How are you, Anita? Again, small group, ask lots of questions. First thing we got to do is start to think about how much profit am I trying to generate in my business? And I love this little image here. If people aren't laughing at your dreams, then it means that your dreams aren't big enough. I really believe that. I truly believe that the human nature is to play small ball. You know, in the book, The Millionaire Real Estate Agent, it opens up with this sort of fable. And in the fable, has anybody read the MREA? Does anybody know the story that I'm about to tell you about the shepherds?
I've started reading it, not there yet.
Okay. Here's the story. The story begins in the book with the father and the son and their shepherds, and they're out watching the flock and guarding the flock. And it's night, and the wolf comes. And it's this teaching moment for the father and the son. And because now the son he's got the rifle, and he's going to try to protect the sheep. And the father says to the son, look, he says, here's what happens. He says, I can tell you from experience that in the dark of night, in the chaos of the moment, with your anxiety and your nerves, what tends to happen is you're going to aim the gun at the wolf, and you're going to aim too low. And he says, what you have to do is trust me, just aim higher than you think you need to in order to hit the wolf. And so the son takes his father's advice, and he aims the gun, and he aims it just a little higher than he thinks the moment would require. And he shoots the wolf, and he kills the wolf, and he saves the flock. And it's this, I think it's a Russian fable actually, but the fable is kind of this idea of saying, look, you know, aim high. If you really want to get things done, you've got to aim high. And so I do love the idea of dreaming big dreams. You know, when I ask agents, and I've been doing this for almost 2 decades now, when I ask agents, how much money are you trying to create in your business? What do you think people tell me? There's one thing that I hear more often than anything else. What do you think it is? How much money do you want to make? If you had to guess, what do you think the answer would be that I hear more than anything else?
Not sure yet, but the other day I was watching the business module with my husband, and we were trying to go from how many people you need to do the business with, from the sellers and the buyer side, and come down to how much you're going to make, and then or you go from bottom up, right?
And so yeah. in that video, what we were talking about is that was from a little clip from 3612.3, and what we talked about, if you were trying to get 36 transactions, how much dollars would that be at your average cost to sell? Here's what I was aiming for. When I ask agents how much money are you trying to make, here's what they tell me: I want to make a lot of money. And that's great. I got no problem with people making a lot of money in real estate. You can make a lot of money in real estate. I've been blessed. I've made a fairly good amount of money in real estate. The problem with that answer, though, is it's not precise. And why it's not a good answer if it's not precise is because unless I know exactly where I'm going to try to get to, I don't know how many transactions it would take. And if I don't know how many transactions it's going to take, I don't necessarily know what mix of activities I have to engage in to produce that volume of business. So I always ask people to get precise and give me a specific. And it doesn't have to be your forever number, but what are you aiming for this year? And then usually what happens is when I ask people to give me a specific destination, they give me a number that says $100,000. I want to make $100,000. There's something about a 6-figure number that seems to feel successful to folks, that seems to feel like a good number to aim at. And I'm going to tell you, 70% of the time or better, Once I ask people to give me a precise number, I hear $100,000. But here's the thing. You have to recognize that the money that you make in this industry is not all yours. You have to share it with other people. You have to, a percentage of that has to be going to the brokerage. A percentage of that has to be going to the franchise group. Now, in our model, in our business model, the good news is that both of those percentages are fixed and capped. And so we know what it's going to be. It's going to be 6% of all your gross commission income is going to go to Keller Williams International, 6% with an annual cap of $3,000 per agent per year. And so what does that cover? Well, what that covers is things like, and if you don't know what that covers, then it's a junk fee. So you need to know what that's paying for. That pays for the technology. That pays largely for the development of the tools, the command and all that stuff. Gary Keller has chosen to invest $1 billion over 5 years to build Command to be this amazing platform for an agent to run their business on. But as $1 billion committed, we're not a publicly traded company. We don't have stock that we can sell. The only way we get that money is through the 6% that goes to pay for the franchise, right? So that's good. So some of that money goes there. Some of it goes to your brokerage. Some of that money has to be put aside for the taxes. And we're going to talk about that specifically in a moment. Some of that has to be put aside to actually run your business. And here's what you'll learn. What the model would suggest is, from a 40,000 foot view, just in general terms, for every dollar that you generate in real estate, you should anticipate keeping somewhere between 35 and 40 cents as profit before taxes. 35 and 40 cents before taxes. That's what typically it takes. And we can get into the weeds in other classes in terms of how we come about those numbers. In short, it kind of comes out to be about 30% going to the brokerage and about 30% being your operational overhead. Now, truth be told, and if you go into the business planning clinic that is online, that 30% that we allocate to run your business, you can and should and will largely do it cheaper than that, because some of that 30% overhead is allocated to cover paid staff salary. Well, as a solopreneur right now, you're not paying people typically. You're doing the work yourself and keeping that money. So your profit margin can be higher. But my point is this: you can only fund your life on profit. And so what you have to figure out is, how much profit does it take to create the life that I want for myself and for my family? And dreaming big dreams and not playing small ball. What would that really look like, so that we can build back a pathway that says, in order to generate that much profit, you have to generate this much gross income. And at the average commission that you have based on your average price point, then how many units would that be? And once you know how many units you're looking for, what we would suggest is probably half of those units would be listing side and half of those units would be buyer side. And the reason for that is because we recognize that buyers typically are the byproduct of controlling the listings. If we control the listings, the buyers come to us through our marketing efforts. And so if I know how many total units, and I say half of those, or maybe 60%, would be listing side units, then I can start to work backwards and say, okay, what would I have to do to make that many listings materialize? And it gives you an opportunity to create a plan of action. The first thing that we've got to do from a finance standpoint is have precision. Have precision in the profit goal, so that we can back into the gross commission number and all the activities that we will take and that we will partake in to make those numbers show up. That's the first step, is knowing what that goal is, and spend some time and talk about it. Spend some time thinking about it. Talk to your spouse, talk to your kids, start to get a sense. Now, your kids don't get to pick, right? And your kids, this is your life, this is your plan. But your kids have a vision of what they want life to look like for them too. I encourage everybody, get all the stakeholders to some extent that you're comfortable in that conversation, create a picture, create a profit goal, and then let us help you work backwards to create a plan of what would it take to make that happen. Step number one, profit is good. Profit is important. If you're not making profit in business, stop, reevaluate. either change your plan or find a new business because that's the reason why we're on this planet, is to create a life worth living, and you need money to do it. So step number one, what is your profit goal? Now I'm going to move into something that we don't talk about a lot in real estate. And the question is, what's the right business structure? You guys realize and understand that you're independent contractors. It is a tax classification as much as anything else. But the other side of being an independent contractor, there's pros and cons. I think our industry has done a disservice in many ways by choosing to make all the agents independent contractors. And one of the disservices, I think, is that as an independent contractor, your employer, technically, your brokerage, we can't tell you what to do. We can't tell you how to do it. You are an independent contractor. You have total control over your schedule. We can't tell you what time to go to work. We can't tell you how many hours to put in. We can't control that because that's what employers do. You're an independent. The challenge with being an independent is that a lot of times you haven't really developed all the skills yet. And you're going out there and trying to market yourself as a professional who knows all these different things. The ICA status is a tax status, and it may not be the best tax status. And so one of the things you have to think about is this: as an independent contractor, you're doing business and you are filing your taxes on a Schedule C, and your taxes are going to be taxed at your personal income tax rate. And that may be perfect. I'm not going to make any recommendations for you. I am going to encourage you to have a conversation with your tax professional and maybe your attorney if you think that's important, to start to figure out, does it make sense to create a different business structure? And when you start to think about what those are, there's formal businesses, there's informal businesses. Most of us are on this side here. We're informally working as sole proprietors of our businesses. We're filing our taxes as a Schedule C on our personal income taxes. Our taxes are taxed at our personal income tax levels. Many people decide that perhaps what they want to do is form a limited liability corporation or an LLC. Now, has anybody ever created an LLC, or is anyone familiar? I think, Juan, you might be. Have you and I talked about this before? Unmute if you would and just jump in on this conversation for a minute.
I think I brought it up earlier in the week, Hal. This is Hugo.
Hugo. Okay, good. Yeah, we talked about LLCs before, right? And so one of the things that I think personally, for me personally, this is just the way I run my businesses. I like to have a firewall, a protection. And what happens is, if you're running your business as a sole proprietor and you're running it as an independent contractor, if you were ever sued, one of the things we're going to talk about at the end of this session is making sure that you've got the right insurances to protect yourself. You have errors and omissions insurance. You would not be working here if you didn't. Errors and omissions insurance is great. It covers errors and it covers omissions. It covers mistakes. However, if you ever get accused and found guilty of committing fraud, your errors and omissions will not protect you. And you start to say, well, look, I'm a good person. People who are frauds are bad people. I wouldn't commit fraud intentionally, and so I'm probably not worrying about that. Well, there's things that can kind of get you into trouble, and we're going to do on Friday a session on how to stay out of trouble, how to not get sued. Because many times, failing to disclose things properly can kind of get you into some trouble. Treating people differently, right? Treating people differently can kind of get you into some trouble. If you require as a regular practice that you require people to produce a pre-qualification or a pre-approval from a lender before you show them homes, then what I would suggest is you better make that your practice across all of your clients. Because if you only do that for folks that you're concerned about their financial capacity, or someone that you know, and you know they have a good job and you know they have good income, and so you're willing to show them homes and get the pre-qualification later, but somebody who you don't know, you require that ahead of time, you're setting yourself up for potentially a discrimination case. And we'll talk more about that on Friday, but you're setting yourself up for potentially being accused of making the decision based on something other than what you intended, which was, I know him, I know his financial capability. I don't need to actually get the documentation, but you could easily be accused of the fact that the reason why you chose to do that was because of gender base or because of racial bias or because of something else, which is really hard for you to defend. And if you were ever sued for that, that ain't going to be covered in your E&O insurance, because that is not an error and that is not a mistake. That's a bad decision. And so I don't think that would happen to anybody here. We'll talk all the different things on Friday, not to get you to freak out, but just to know what to do things the right way. But from a business structure standpoint, if you got sued as a sole proprietor, everything that you own can be part of a settlement. Not just your business, but your house and your IRA and your kids' college fund and everything. It's all fair game because you're running your business as a solo proprietor, as an individual. If you were to become a limited liability corporation, what that does is it gives you the protection of saying there's limits to my liability. And the limits are based on how much is my business worth, not my whole net worth, not my family's net worth, not my house and my cars and my kids' college fund, but how much is this business worth? And the only thing that could become subject in a settlement is the value of the business. I think it makes a lot of sense to do that. You have to decide with your tax professional and your attorney if it makes sense for you too. If you become a landlord and you own properties, which I would encourage you to think about. You are in a great business to become really, really smart about property. What's a good deal? What's not a good deal? How could you become an investor yourself? Many people hold those investment properties under a limited liability corporation. Because if a tenant ever had an accident on the property or something happened in the maintenance of the property that caused, God forbid, some terrible event to happen and someone got injured and someone got sued and they sued you, because the property is held inside a limited liability corporation, it's only the value of the corporation that can be a subject to a settlement claim, not your personal property. And so one of the things that you have to think about is, does that make sense for your business? And there's a lot of folks who say it does, and there's a lot of folks who say, I'm not concerned about that. I'm not going to say what's right or what's not right. But I would say you need to have that conversation with people who can advise you. And so an LLC is a corporation. There's a sort of a C corporation. There's an S corporation. I'm not going to get into the weeds of all the different ones. What I'm just going to encourage you to do is find somebody that you trust to guide you there and have that conversation, right? Last but not least, in real estate in New Jersey, we kind of are strange here. If you do decide to do your business under an S corporation or an LLC, for example, New Jersey is only allowed to pay individual people, individual agents, commission dollars. If you created your LLC and called it Perule's Really Cool Real Estate Company, right? If you did that, you can't go to your MCA, your Market Center Administrator, when you have a commission check and say, can you cut that check to Perule's Really Cool Real Estate Company? Nope, can't do that. Can only cut it to you personally. And then you'd have to take that personal check and you would have to, because you are the owner of that LLC, when you create your bank accounts, which we'll talk about in a moment, you can deposit a check made out to you into your business account because you have the authority to do that as the owner of the business and the owner of that account. That's how you have to do it, right? That's how you'll get paid.
That was my question coming up to you. It's like, should I make a completely brand new account for myself?
Yeah, we're going to talk about that next. Hold that thought. And the answer is yes. And it's not just one. I would recommend several. If you do become an LLC or a different business entity, you're going to have to get a different a business tax identification number. And you're going to have to file your taxes using that EIN, that employee identification number. Not complicated to do, guys. An attorney can do it for you. There's companies out there. Some of the companies I've started in the last 5 years, 3 different businesses, all 3 of them as LLCs. And I used a company called CorpNet, like Corporation Net, I believe is what it is. And they're a company that does a lot of different things to help businesses start up. And they created the LLCs for me. They filed all the paperwork with the state. They filed all the paperwork with the IRS. They got my tax identification number for me. They filed with the Division of Consumer Affairs. They handle my annual reporting, not my tax reporting, but my annual reportings that I have to submit to the state about the business. They handle all of that, right? There's services that can do it. But I would encourage you, step number one, decide what's the right structure for your business and know that there's risks and benefits of doing it each way. Decide what's best for you. All right, moving on. Let's talk about the accounts. And some of what I'm going to share with you is coming from this book right here, Profit First. The one and only Michael Michalowicz, a guy from West Caldwell, New Jersey. Frankly, in my mind, one of the smartest business guys in not just real estate, but just one of the smartest business thinkers. He's probably written a half a dozen different business-oriented books on how to be entrepreneur, how to be a great entrepreneur, and how to run a great entrepreneurial business. And what he talks about is how important it is to run your business like a business with different bank accounts. What so many agents do as sole proprietors is they get a commission check, they stand next to the bell in your office and ring the bell, wearing the mask, doing the happy dance. We put it up on Facebook and everybody hoots and hollers and it's great fun. And then we take that check and we go and we put it right in our family's bank account, right in our family's personal checking account. We deposit it there. And what he says is, what Mike says is, that's not the way businesses work. You got to have business accounts. And I'm going to tell you, when the COVID-19 pandemic hit, and what happened was, what we found was real estate agents suddenly were eligible for certain kinds of relief. They were eligible for PPL loans. They were eligible for unemployment. They didn't always get them because, being eligible and actually working through the bureaucracy turned out to be a whole different animal. But what happens is those personal loans, the PPL loans, were being facilitated by the local banks. And you had to have a business account with that bank in order to qualify. If you have a personal checking account, that doesn't make you eligible for a business loan, a business bailout. You need a business account. And so what I encourage you to do is go to your bank and set up a separate account and make sure that it's set up as a business account. And if you're going to do it as a sole proprietor, you'll need to provide your social security number. If you're going to do it as an LLC, you're going to also need to provide your tax identification number, your EIN. You're also going to need to provide some articles of incorporation to show that that LLC was properly formed. And again, if you have a professional handle this, and for me, CorpNet will do this. It's less than $500. It's not a huge investment. But when you go to the bank account, what you're going to need is a separate bank account for your business. And what Mike says, what Mike Mallett says in Profit First, he says you actually need, in his recommendation, a couple of different bank accounts. And I'm going to go to those bank accounts in a second. I have to talk about the name Profit First. What his whole premise of this book, and I'd encourage you to go get it, and I encourage you to read it. We might even do a book study on it sometime in our group here. But what he says is, there's this idea that says that businesses kind of spend to the limit of what they have available to them to spend. There's this thing that we call the Parkinson's Law, and Parkinson's Law really has to do with time management. And what Parkinson's Law says is that the work expands into the amount of time that's available to complete it. If I have to clean my garage and I have a week to do it, I'm going to spread the work out. I'm going to get it done in a week. If I have to clean my garage and I've got to get it done in 2 days, I'm going to get it done in 2 days. The work always expands into the amount of time that we have available. That's called Parkinson's Law of time management. Well, what Mike does is he takes that idea and he applies it into businesses and expenditures. And what he says is businesses have a way of spending the money to the extent that they have to spend. And when there's no more money to spend, they stop spending. And when there's more money coming in, they spend again and again and again. And what tends to happen is we think about profit as an afterthought. At the end of the year, we close the books and we hope that once we pay off all our debt, that there's enough money left over for profit. What Michael says is that's the wrong way to do it. If you really want to guarantee profit, what you should do is you should put the profit aside first. It's almost like in some religious traditions, there's this idea of tithing, right? And in certain traditions, I know in the Christian tradition that I grew up in, the idea of tithing was you take 10% of your income and you put it aside first. And you donate that to whoever is kind of supporting your spiritual life and whatever. And there's lots of different cultures that have some variation of tithing. But what Mike says is you put your profit aside first, and then when you have whatever is left over, you're going to spend to the extent that you have no more money. And then at the end of the year, you're going to guarantee that that profit is there. You get another check, put the profit aside first, and then spend to the extent of what you have left. My mom, I used to have, as a kid, we grew up in a family, we didn't have a lot of money. In order to make sure that my mother could afford to buy Christmas presents, she used to take a certain amount of money out of every paycheck and just put it aside. And the bank had something called a Christmas club back in the day. And she would put $10 or $20 or whatever it was. And at the end of the year, after doing this, every paycheck that she earned as a secretary, at the end of the year, she had a few $100 and she could go buy presents. That's the idea of profit first. Guarantee that your profit is going to be there by putting some of the money into a profit account first. And so he says there's 4 different key accounts that you need. Number 1, business account is your operating account. When you get money, when you get a commission check, you put that commission check into the operating account. Then what do? You start to distribute out from the operating account into these other key accounts. I'm going to put whatever I'm going to put, however percent I want to put aside for profit, I'm going to put that into a different bank account that's called a profit account. And so I'm now opening up 2 accounts. And what Michael would say is if you're really going to honor this idea of guaranteeing that your business is profitable, and the purpose of business is what? To have profit so that you can do what? Fund your life. If you really want to honor this principle, what Mike says is put your profit account in a different bank, in a different institution. Because when you get into a spot where things are lean and you want to spend money and your operating account says, I don't have any more to spend, if it's in the same institution, it's really easy to just do an account transfer. If it's in another institution, there's going to be a built-in speed bump there. You're going to have to go get it. You're going to have to bring it in, and it's harder to do that. And it just makes it harder for you to violate the notion of protecting your profit. Account number 1, your operating account. Account number 2, your profit account. Account number 3, let's jump down to the bottom. Let's talk about the tax account. You've got to put the money aside for taxes so that they're there when taxes come due. Now, let me ask you guys, small group, only 4 of us here. When are your taxes due as a real estate agent? When are your taxes due? Do you know?
When you get paid.
What was that? Say it again.
April 15th.
When you get paid.
When you get paid, and then I heard something else. Somebody else is saying something else?
Isn't it April 15th?
April 15th. You know what? And here's the deal. It's not really. And we're going to, well, I'll have a slide on this in a minute. But the IRS law says, the IRS rules are you owe the government the moment you get paid. The government wants their money the moment you get paid. Now, when you're working in corporate America, you've got a payroll administrator who takes your hourly rate or whatever you are. If you're on a salary, you're going to take your salary. Your payroll administrator is going to take some of that money out and wire it right to the IRS right away. They get their money in real time, and then you get what's left over, right? And then in corporate America, at the end of the year, you're going to have to kind of figure out how much did you really earn? How much did you really withhold? Did you pay too much? Did you not pay enough? And on the 15th of April, that's when you balance the books and figure out how did you do. But make no mistake, the money is due the moment you get paid. Now, as an independent earner, because you get paid infrequently or not necessarily infrequently, I want you to get paid very frequently. I want you to have lots and lots of closings, but you don't get paid in a predictable way. And because you're an independent and you're an employee of one, the IRS doesn't have the manpower to handle a submission to them every time you have a closing. they can't process it, that much stuff coming at with all the independent contractors in the world. So what they say is 4 times a year, we're going to ask you to estimate how much you owe us in this quarter based on your earnings. Just estimate it. Send us what you think. And then on the 15th of April, then we're going to balance the books again. What we need to make sure of is that money, and I'll give you sort of the dates for those quarterly installations in a minute, we got to make sure that money is there so that when it's time to send our estimated payment, we have it. What happens a lot of times, and I know because I have done this myself and I've seen other agents do it, is if we just take our money and we blend it in with our family's bank account, we kind of forget that that's not all ours, that some of that should be put aside to pay Uncle Sam. And what really good agents get the belief is that if you get really good at creating wealth, creating income, you feel like I can spend it this time because I know I'm going to be able to generate another closing and I'll pay the taxes out of that one. That's a dangerous game. That is a dangerous game. I'm not going to call anybody out. And the good news is there's nobody on this call. And I don't know that it's anybody in any of your market centers, but I can think right now, off the top of my head, I can think of a half a dozen agents that I know, good, solid real estate agents, been in the business a long time, that owe the IRS in excess of $100,000 in back taxes because they spent the money. And when the IRS came calling for it, it wasn't there. So what you need is another account to just put that money aside to make sure that it's there. So you have an operating account that receives all of your income. Some of the money goes to your profit account. Some of the money goes to your tax account. And then the final account would be a payroll account. Mike is a big fan, and I think it makes sense. Pay yourself a salary, right? Because salary and profit are different animals. Profit is how much do we have left over after everybody in the company got paid. You're part of the company, you should get paid. If you have profit on top of that, that's a bonus. You have to decide how much do you want to draw as salary consistently and regularly and pay yourself that salary. Now, in a startup business, when you have to invest a lot of money to kind of get the business going, you may defer salary for a while. You may take a very tiny salary for a while because that money's got to get poured into the business to make the business grow. That can happen and probably will for most entrepreneurial startups. But the 4 key accounts that you want to have is an operating account that you put your revenues in. When you get paid, it goes into operations, and then it gets distributed into the other buckets. And I'd encourage you to go think about starting those accounts right now. At minimum, you have to have a business account separate from your family's finances. You just have to. You cannot commingle your business money with your family's money. That's just a recipe for problems. And so set up these accounts. Any questions around these before I jump into some other things?
Won't the payroll account be before we calculate the profits?
Yeah.
Right.
Yeah. So let's think about it this way. If I have $100 coming in, and let's just say okay, I just want to put $5 into my profit bucket for now. I'm going to probably assume maybe 30% tax bracket. I'm going to put $30 into my tax account. And then I decide how much money I'm going to draw as salary. I've got $5 to profit. I've got $30. Now 35 of my $100 is accounted for. I've got $65 left. Maybe I pay myself a profit of $30. That means I have $35 left in operations to run my business on. And, Parkinson's law says that we spend to the limit that we have. If I don't pay myself a salary, my salary is being used to run the operations. And in the beginning, you may need to do that. But the sooner you can carve out a salary and pay yourself a salary, I think the cleaner it becomes, the easier it becomes, the better it becomes for your business. Does that make sense?
Yes, it does.
Okay. Now, how much do you pay yourself? Well, that's an interesting question. If you study the CEOs, and guys, you are the CEO of your company. Congratulations. You just got a big promotion. Didn't say you got a big salary yet, but you got a big promotion. You're the CEO. If you look at CEO salaries in the United States, what you're going to find is the median For someone running a company between 10 and $25 million in revenue, right? 10 and $25 million in revenue. Now, keep in mind, for us, our revenue is not $25 million worth of homes sold. It's $25 million of gross commission income brought in. It's a pretty good size business, but there's plenty of people in your market centers today that are making that kind of money. The CEO of a company of about that size usually earns somewhere around 50 to 53%. That's what they keep as their CEO compensation. So if you're running a business of that size and you had $100, keeping $50 of that roughly as your profit is probably what you're worth. And you got to pay yourself what you're worth, right? So think about that. You know, don't shortchange yourself, but understand that the value of the CEO in the company is to be able to grow the company. And so if you haven't grown the company yet, you might not have earned the right to that kind of a salary yet. But that's kind of the ballpark for what you start to think about, right? Anyway, create the profit account, create the payroll account, pay yourself, right? Now, we said when our taxes due. There is a quarterly schedule for when the estimated taxes are due. This year, that schedule changed a little bit with COVID. But generally speaking, one installment is usually due on or before July 15th. There's another installment that's due usually in November, another one in September, and then in January. This screenshot here that I clipped off of Google kind of has a different schedule because of COVID. It changed this year in 2020. But go back and look and just figure out when are the estimated dates due, because you will be asked to start to calculate how much did you make in the quarter based on your taxes, how much did you put aside and how much did you forward, and stay on top of that. There will be penalties if you underestimate or you don't pay it on the schedule date. At the end of the day, as long as they get their taxes from you, they're going to be happy, but they will charge you a penalty if you don't do it in these quarterly installments and you do it just once a year. They're going to penalize you for that. You're going to pay extra. You're going to pay a fine. Now, what does taxes include? How much do you have to put aside? You've got to recognize we've got state taxes, we've got federal taxes. I say your mileage may vary because depending on how you're running your business, what tax write-offs you have in your business, you know, that number that you should put aside is variable. But make no mistake, if you are a sole proprietor, independent contractor, you also owe the state taxes and the federal taxes, but you also owe what's called self-employment tax because you're self-employed now. And self-employment tax covers kind of the things like Medicare and Social Security retirement and all those things that you fund through payroll that if you work for another corporation, they would be paying part of that. Because you're working for yourself, you're paying the whole thing. And according to the IRS, 15.3% of your gross income is what you owe in self-employment tax. So when you think about state and you think about federal and you think about self-employment tax, you roll it all up. What we usually advise as a benchmark here at Keller Williams is think about 40%. 40% of all your gross income should be set aside for taxes. And what I hear when people go to their tax professional and they ask that question, many times they say 40% is too high. This is why I think it's better for you to be 30% or 25%. You talk to your tax person and get the advice that's best for your situation, but make sure that you're taking out enough to cover all the things that's required of you. State, federal, self-employment. If you're working as an independent contractor, sole proprietor. If you do incorporate as a business, here's where it gets squishy and different. Businesses get taxed differently. And businesses, generally speaking, get tax preference. Businesses get tax breaks. And so if you look, typically on average, a small business tax rate is not closer to 40%, it's actually closer to 19 to 20%. Businesses pay different taxes based on the type of entity that they are. You know, you can sort of see here, this is just taken from a small business tax thing that I took off the internet just to give you a snippet of what it could look like. Generally speaking, sole proprietors who are incorporated as LLCs are kind of in the 13% range. Partnerships are kind of in the 23, 24% range. S corporations in a different range. What will happen, generally speaking, is that if you take the time to become a business incorporated entity, whether you choose to be an LLC or an S Corp or a C Corp or whatever, generally speaking, you'll save some tax dollars because businesses are taxed in a more preferential rate. That could be another reason to think about the business structure. I'm not going to give you advice. I'm not an expert, and I did not sleep in the Holiday Inn Express. I want you to have this conversation with the people that you trust to guide you properly. Okay? But make sure you put the money aside. Now, review your finances regularly. It's just one of those things. As you are running your business, you want to just look at it on a quarterly basis, a semi-annual basis. If you're doing a bigger business on a monthly basis, how are our numbers? Are we on track? Are we taking enough out? Are we putting enough aside? If I deferred taking salary in the beginning because I needed to spend more money to kind of ramp up the business, is the business growing to a point now where I can start to take salary? Right? Those are things that you want to just look at it consistently, look at it regularly. And then finally, you got to prepare for a rainy day. Are you putting money aside for things like not just running your business? Do you have a kid's college to take care of? Are you funding that properly? Do you have a wedding to plan for? Are you funding that properly? Are you planning for your retirement? Guys, the vast majority of Americans do not have any net worth outside of their home equity. That's one of the reasons I'm so passionate about real estate. For most Americans, their home equity is their entire net worth. What I want you to do is plan. Because, when you retire, I want you to be able to have enough revenue to live on, and start thinking about how much money do I have to put aside, again, from my salary, from what I pay myself. This is not your business expenses now. Once I pay myself my salary, how am I allocating those funds to make sure that I really am funding my perfect life? And putting that stuff aside and thinking about how much do I need to keep chipping away for the college fund or for the mom and dad's retirement fund or whatever it's going to be. Maybe it's a vacation fund. Maybe you're squirreling away money for an investment property, whatever it is. Kind of get those little buckets sort of set up and fill those when you have money coming in, right? Fill those. Finally, protect yourself. Protect yourself from the standpoint of a business structure, to put a firewall between your business and your family assets. But then think about all the things that could impact your family assets. Do you have adequate insurance? Yeah, you've got errors and omissions insurance for your business. That's great. Do you have adequate homeowners insurance? Do you have adequate auto insurance? If you've not spoken to Tim over at Carnegie Home and Auto, right? Carnegie Home and Auto is an insurance company that we own. Bergen County Partners owns this insurance company. And you should reach out to them and see if they can get you a better deal. I was talking to him recently, and he was telling me about an agent that was, I think, in the Woodcliff Lake office. And what he did is he took a look at their insurance. And what happens with insurance a lot of times is you get it and you forget about it. And sometimes your insurance that you purchased at the time isn't adequate for what you need right now. But what Tim found is that, when he repackaged and he went to a different provider and he repackaged their home and auto and all the different insurance, he saved them $4,000 a year. Make sure you've got adequate insurance. Have Carnegie Insurance take a look and see if they can get you a better deal. But then think about the other calamities that can be a real problem. If you got sick, do you have health insurance? And I know that what sucks about the real estate industry is we don't provide it. We cannot provide it because as an independent contractor, health insurance provided by an employer is an employee-sponsored benefit. So we, by law, cannot provide insurance for you. That should change. That is wrong. We got to fix that. And that's a political issue that I don't want to get into today, but we got to fix that for small business independence. But do you have health insurance? If not, can you get it? Where can you get it? How much can you afford? Because God forbid, you could get sick and all of your personal assets could disappear. Do you have disability insurance? Do you have long-term care insurance? Many people think and sort of financial planners sometimes will say, and I'm not a financial planner and I didn't sleep in a Holiday Inn Express, so I'm not trying to give you advice. But my financial planner said, look, you need health insurance to a certain point, not health insurance, rather. You need life insurance to a certain point. You need life insurance so that if you died and people were dependent upon you and there were expenses that needed to be paid, that there would be insurance to make sure that those were covered. But once your children get to a point where they're not physically, financially dependent upon you anymore, once you've paid off certain debts, then maybe you don't need life insurance as much as you think. Maybe what you need to do is to take those premiums and shift them into a disability plan or a long-term care plan, so that as you got older, if you needed to, God forbid, nursing home care, or you needed home health aides to come to your home to care for you at some point, that you've got insurance to cover that so that you don't have to squander all of your assets. Go back to the millionaire real estate agent for a second. What we said was the premise of that book is earn $1 million, net $1 million. And I said it goes all the way to leave $1 million. Well, you're not going to leave $1 million if you have to pay for care as you get older. And so do you have the right insurance there? I can tell you, as someone who bought a long-term care plan about 2 years ago, what my financial guy says is, look, when you're in your 50s, you can buy this plan to cover you all the way through till you're 100 years old, but your premium is going to be super cheap if you buy it in your 50s than if you don't think about this until your 70s or your 80s. Then you're not going to be able to afford it. And so the last slide here is find a financial consultant who you trust and think about your insurance. Are your assets that you're working so hard, the purpose of what you do all day is to earn profit so that you can create a great life, protect that life. Make sure that to the extent that you can, you've got the right insurance. And guys, if you had to make a decision of paying for the insurance to make sure it was there, or paying for something else that's more pleasurable, maybe a vacation, maybe a boat, who knows what it is, I would encourage you to think about protecting your assets first. And then just earn enough money through the growth of your business so that you still have enough residual income to enjoy yourself. But you've got to make sure that you've got the right protections. All right, guys, it is after 4. We're going to park this here because I do actually have a 4 o'clock appointment that I'm going to get to a couple minutes late. But I do want to just kind of ask for some takeaways, as I always do, right? What's the most important light bulb that you heard today from what we talked about here? What's the thing that you're going to start to go and say, this is what I'm going to focus on next? Anything?
Protecting yourself.
Protecting your assets, right?
Yeah.
Yeah, man. I'm telling you, Juan.
That's big.
That's big. That's huge. I used to run hospice programs. I ran before real estate. My final healthcare job before I got into real estate was the vice president of operations for the largest home care hospice program in the state of New Jersey. We were part of the St. Barnabas healthcare system. I can tell you, when people get to a point where it's end-of-life care, I can tell you there are so many people who just don't have the funds to pay for the care that they need or that they deserve. And that's so tragic. And you can protect your assets and insure yourself now. That's so important to do. So I'm glad that's a light bulb for you. Any others?
To really organize, categorize, and kind of put together the whole plan, basically, for your business. And it's the way you even explained to make separate accounts just makes so much more sense now than just putting everything in one and thinking that, oh, I organized it. Yes, I'm going to get that.
Go get profit first. Mike's book is, the guy, I'm going to tell you something. The guy is a genius. He's a Jersey guy. He can be a little rougher on the edges sometimes, but he is absolutely super smart. Read that book. I think you're going to get
great. My husband is in investment banking. I'm sure he knows a lot. I never paid attention to finance and everything because I thought, that's his side of, he's taking care of stuff. But
invite him into this conversation, and together you do it together because he knows a lot of this stuff. And just make sure that you've got the right structures.
Yes.
Right? Think about your business structure. Think about the account structures. Think about the insurances that you're going to need. Think about what would you do? How would you pay yourself a salary? How much would that look like? if he's a finance guy and thinks finance ways, then it's going to be easier for him to kind of help you with all of this.
Yes, that's why I made him watch your business module, and
The poor guy,
very
man.
happy.
These guys,
No,
I
he
can
was
take the poor
actually
guy
very
out for a
happy.
drink at some point. He's putting up with too much of me.
No, he actually was very happy. So no, this makes so much sense. I thought I'll skip this class, and because I was running around with the kids and getting things done, but this made so much more sense.
Well,
And
here's the good news. We covered a lot of ground here, and this has already been recorded, and this is already on the YouTube channel. So if you want to go back and watch this one with him too, this one is in the New Agent Launch playlist. I recorded it a couple sessions ago. It's not exactly the same word for word, but we cover all the same issues. And you may want to go back and watch that with him too, and start to think about these things.
it makes more sense because I just gave in my personal account right now because I in the start didn't know when I was doing the contract, but this makes more sense to, categorize and organize everything and just like put everything in the right places.
Yeah. Just like everything else, when you start with the right format, when you set it up right in the beginning, then everything works. When you try to superimpose a structure on things once things are going, it's harder to do.
It's very hard.
So just take the time, get it all set up right in the beginning, and then as you have income, you just start doing it this way. And it's just a lot smoother way to do it.
And we both are very organized people, so I rather do it in the start before I get bombarded with things and I get more confused.